Hey, welcome back to the channel. Today we're going to be checking out Academy Sports and Outdoors, ticker symbol ASO. All right, looking at the 5-year chart, we can see it's up about 326% currently over the last 5 years. We're in a bit of a pullback. Recent highs is around $67, currently sitting about $55, with a recent low in June of around $48 a share. All right, so here we have the latest investor presentation. So let's breeze through it and see what we can find. Now, this is pretty interesting, kind of a couple of slide decks where they basically go over why they used to suck previously. In fiscal year 2020 or 2013 through 2018, just kind of their lack of growth despite growing 70 stores, not a strong operator, just kind of almost like almost trashing themselves through this time period, which I mean, yeah, pretty much. But it's interesting to see them kind of like own up to that and actually have that in their investor deck. And then in 2018, it looks like they kind of put in some effort to turn things around, change the culture of the company, make it a better workplace, better employee satisfaction, and kind of focus on the growth over the next 5 years of how they could actually start putting out some decent fundamental growth, ROIC. You see net income margin, EBITDA margin, prior 2023 goals. So it looks like they started actually, I don't know, taking things a little bit more seriously. And here we are today. A little boast of their unique assortment of brands, which I mean, I guess, yeah, good that you have decent brands, I guess. So then omni-channel capabilities, just basically multiple ways to actually order products, buy their products in store, on the app, online. And then you can kind of see here that they delivered basically early on their 2023 objectives. So they basically were able to do that, about a year early. However, it'd be kind of interesting to see, how much the COVID tailwinds and all that spending when people were stuck inside or had to be outside, how that kind of help them reach these goals that much quicker. And then they go into kind of a sector comparison with some of their competitors as far as sales per store, EBIT per store, or EBITDA per store, sales per square foot, and just kind of showing the efficiencies that they've been able to come with over the last several years or 5 years as they have kind of changed direction of the ship. And then, stock price. So yay, they created value. Good for them. Good for them. What are they going to do going forward, though? So let's see if we can find that. And we did not have to go far. Here we go. Let's see what they're planning in the future. All right, so it looks like they're planning on expanding store base by about 50%, continue building a powerful omni-channel business, drive existing business. So basically just actually remain efficient operators, and hopefully they can expand that to, 50% more stores and scale over the next 5 years. And then their 2027 goals of net sales of 10 billion, net income margin of 10%. So what that's about, like what, billion in net income. Adjusted EBIT margin of 13.5, return on invested capital of 30%. That'd be pretty. That would be pretty. Inventory turns 3.7, net sales 365 square foot, and .com penetration of 15%. So that's most likely them just saying that 15% or 15% of the 10 billion would come from their e-commerce lines. And it looks like we got some slide decks on the leadership, CEO, and then the TAM, the 2022 TAM. Oh man, 13 billion plus 27 billion, 47 billion, 88 billion, so much. 175 billion in TAM. But they do kind of show that they are gaining market share in these different kind of segments: apparel, footwear, firearms, team sports and equipment, fishing. So as long as they can continue gaining that market share, expanding stores, operating efficiently, with good margins, improving their supply chain, their ease to order, you could have a decent runway. and get to that $10 billion revenue mark and the 10% net income margin, so billion in net income. Then we get a little bit of a breakdown of their customer base, brands again, and then we kind of have path going forward again. Reiterated, store base by 50%, omni-channel, existing business, drive the current efficiencies that they have from the operating side, scale supply chain like we talked about, and support the best team in retail. And then we kind of get a interesting insight into lowest performing stores are at profit parity with the largest sporting goods competitors. So basically they're saying even our bad stores are doing better than the other guys. So ASO average 4 million, largest sporting goods competitor average is 2 million. Out of the ASO stores, the first quartile is 6 million, then second is 4, then we got 3, and then we got 2 on the fourth quartile. Then we can see current markets that they serve, a little distribution center, headquarters, stores in different states. New store economics, ROIC 20% hurdle rates, EBITDA positive in 1 year, 4 to 5 year sale ramp, capital open 5 to 6 million, year one sales target 18 million, kind of what they're shooting for. And here they're kind of pointing out kind of industry tailwinds, just the spend on sporting goods and supplies is growing at a very, very nice clip over the last 20 years or so. But especially in 2020, 2021, and 2022, they've seen a good amount of growth. But is that growth somewhat cyclical? I mean, I don't know. We'll see. We'll see if we see a decrease, kind of a pullback and normalization for the category as a whole. If that happens, maybe we get some weak price action and it leads to some good opportunities. Here we have their 5-year growth plan, 120 to 140 new stores, kind of the regions that they're operating out of. And yeah, it looks like they're not going to be getting into my area anytime soon, unfortunately. So if they could, I could do some real due diligence and go into a store and base everything off of that. Just kidding. And then kind of reiterating their target of 10 billion new stores. It's going to be about 2.4 to 2.8 billion. Today, 6.4 billion. So we'll see some growth from the current stores, and then new stores should hopefully increase that 2.4 to 2.8. And then there is a ton more information in here. So if you want to dig deep into this one, I will link this presentation in the description, and please feel free to kind of take a deeper look into kind of their sales pitch for how they're going to accomplish that hopeful 10 billion in revenue and 1 billion in net income by 2027. But let's go ahead and get into the valuation template. All right, so we're going to go through the financials real quick, and we can kind of see the explosive growth in 2020. And then we kind of normalize, and we're kind of fading back down through 2023 as things compress. And that's kind of, expected. You can't really expect to go through such a crazy tailwind as 2020 and expect that to just keep on going forever. Now, long term, if they are able to meet their goals, we should see this kind of return to trend and kind of pick back up. And we can also see in the free cash flow margins, gross margins, everything around 2020 to 2021 shot back up. And then we've kind of been pulling back here recently. Bottom line yields. Now, we don't have a ton of data to go off of for this company, but we can kind of see historical bottom line yields. We're seeing about 8.54% free cash flow yield right now. So it's yielding a decent amount to the bottom line. Shares outstanding, kind of see a bump in 2021, down in 2022 and 2023. So we'll see. I don't know. That's kind of interesting that they bumped up. Maybe they did an acquisition or something, or they just did opportunistic dilution for continued growth. Now, we aren't going to have a ton of data because I think we only have data going back to 2020 or 2019, 2017. So it looks like my model is just not pulling a ton of data for this one. Let's see. We are pulling back to about 2017-ish, but yeah, looks like the service I use might not be pulling all of the data for this back to 2017. So that's unfortunate. Let's go over the balance sheet. And yeah, same thing. So sorry about that. Apologize for that. That kind of sucks. But even if we cannot see the historical data, historical trends, we can still try to kind of figure out a valuation going forward if they are able to meet those 2027 goals of 10 billion in revenue with 10% net margin. So here we can kind of see the per share metrics over the last 5 years. Yeah, we kind of got that boost through 2020 to 2021, pulled back a little bit now. We also see common stock repurchased and buyback percentage amounts. So they have been repurchasing, it looks like, opportunistically. And yeah, let's go ahead and jump into the evaluation. Now, just looking at the share count, if this is correct, we can see that they have done buybacks here and there. They've also done some dilution, some more dilution, and then some continued buybacks. So I'm not sure. I'll have to check to make sure that data is correct, but if that is correct, I'm assuming that they're doing dilution for capital to raise to build additional stores, and then as that cash flow is coming in, they're just buying back their shares pretty aggressively. 11% in this year, or in 2022 it looks like, and about 5.49% over the last 12 months. All right, so for the valuation on the yield multiples, we can see previously net yield percentage has been about 13% to 18% down to 2%. So I mean, it's hard to kind of get a historical multiple based on this because it's just been kind of so new and recent. But for the forward-looking projections, in the bullish case, what I've done is basically I've chosen a growth rate that's going to pretty much make their net income at that 1 billion mark. And that will essentially assume that their guidance is correct over the next 5 years or so. And well, technically 2027 is going to be 4 years out. So we could probably change that, but we'll say 5 years, 1 billion in the bullish case. So there is a lot of leeway for them to potentially outperform the base case and the bearish case. Especially if they actually do hit that 1 billion by 2027, because that would technically probably be in about year 4. Now, if we go to the multiples, this is kind of hard because right now I've got the net yield. We're not normalizing, but just because we kind of already have normalized the pullback over the last couple of years, we're doing a net income only evaluation. Dilution, this is the one where we can actually potentially do a lot of buybacks, depending on if they have enough capital from their cash flows to do the expansion and they have capital left over, they could continue buybacks. So something to look into would be any buyback plans they currently have in place. And on that note, if we jump back to their presentation, we can just search for repurchases and we can kind of look at their mindset on their capital allocation, capital return to shareholders. So over the next 5 years, to drive stakeholder value and to provide financial stability, they're projecting that they'll have about 3.5 billion for that total expected free cash flow over that 5-year period. So we can see basically they're looking at maintain a great balance sheet, opportunistic buybacks and dividends, and then debt pay down. So we could potentially see a decent amount of buybacks, especially if, the equity is yielding around 10, 12, 13, 14%, and it's very, very lowly valued. They might use that as an opportunity to buy back shares and decrease that float. But it's kind of hard to get a really good projection on exactly how much they would do that because I don't think they have any, at least here, I'm not seeing any direct buyback plan in place where they're saying, hey, we're going to put X amount towards buybacks. So for that, I'll take a wild guess and I'll say, best case scenario, maybe they buy back about 4.6% of their float per year. Very bearish case, maybe 2.4%. But there is the, possibility that they don't really do a lot of buybacks and they do a lot of capital reinvestment, especially if that capital reinvestment into new stores is generating ROIC of 30% like we saw in their slideshow. So but I think there's a decent chance that they will probably, balance the capital reinvestment in new stores to get that great ROIC, put a little bit towards buybacks, especially if the equity is yielding, 8, 10, 13% on a net basis. And then also they have kind of a token dividend right now at 0.6%. And I think the dividend payout ratio is something like 7% or so. So it's very low. which means that they could, all things going to plan, they could grow that dividend pretty substantially, and they could grow the dividend pretty substantially just through the use of buybacks, right? Because then you have less shares, you basically using this same amount of dividend capital payout, you're able to give more money on a per share basis back to shareholders for the same amount, since you're decreasing that float. All right, so we have about bottom line growth of 8.63% in the bearish case, 13.315 in the very bullish case. The bullish case is basically management meeting their guidance of $1 billion in net income after 5 years. The multiples, we have a future estimate of 8.21% yield in the very bullish, and very bearish of 12.51. And these are that's still pretty low multiples, right? We're still talking about maybe like a 10 PE in the base case. So, I mean, that doesn't account for really a lot of multiple expansion or anything like that. But basically, what I see is the potential for this company to just have a lot of power in how they return capital to shareholders, as long as they have that cash flow and it's growing and it's stable. They'll have a lot of levers to pull if they want to do buybacks or share repurchases, or invest into new stores and expansion. So I have a target CAGR of 17.5% with a margin of safety of 2.5%. Target rate's 20%. Given all of this, our bearish or our very bearish buy price would be 37. The bearish buy price would be 45. The base case would be 53. The bullish case would be 65. The very bullish would be 79. And that basically puts us pretty close to the base case buy point right now. 5-year targets under all these scenarios, these theoretical scenarios, if they were to actually occur, the 5-year price target in the very bearish scenario would be 98. 5-year in the bearish scenario would be 117. 5-year target in the base case would be 140. Target in the bullish case would be 169, and very bullish case would be 207. So, yeah, that's what we got for ASO. It's an interesting one. I think if they can keep it up, and if they can keep that cash flow, and they don't kind of normalize too much, they could have a lot of levers to pull to return capital to shareholders. The space, in my opinion, I mean, it's going to be more discretionary, so you're going to have a little bit more risk for the consumer spend cycle. If things get really tough, this is an area that consumers could pull back more on. But unemployment's been really low. Consumer's been somewhat okay so far. But we do have, interest rates increasing and kind of tightening the consumer that way. So, yeah, it's interesting. It's interesting. And I think you would have to have a much better understanding and belief in the business going forward to say if you wanted to make this a position or not. Hope you guys have had a great weekend, a great day, and we'll catch you in the next one.